We're all set.
Thank you. Well, good afternoon, everyone. Welcome to the fifth Power Hour webinar of the year on tax incentives for solar energy, the 101 on the Inflation Reduction Act. My name is Megha Hamal. I am the Chief Strategy and Communications Officer for the Illinois Power Agency. I will be responsible for hosting the presentation today. I'm also joined by IPA Communications Associate Tori Tartaglia, who will be handling the logistics of the webinar on the back end. Thank you, Tori. To get started, let's go over some housekeeping items. To reduce any background noise, all participants are muted upon entry. We will be taking questions from our audience towards the end, but please feel free to submit questions at any time during the webinar. To submit questions, please use the chat feature at the bottom of the Zoom window. Today's session is being recorded, and a recorded version of this session will be available on the IPA website under About Us and Events. Tori, could you please go to slide 3? You can skip the slide 2. Thank you. So a couple of points I would like to emphasize. Today's webinar is for general education purpose only and does not represent a legal interpretation or statement of policy by the IPA or its staff. The 60-minute webinar will explore tax credits through the Inflation Reduction Act as they relate to solar projects for profit and nonprofit solar owners. Additionally, this presentation will discuss the solar tax credit transferability process and share insights on guidance on the IRA domestic content adder, among other items. For those who are new to our IPA Power Hour webinar series, welcome. Power Hour is a series of educational and informative webinars on a wide range of clean energy issues and topics. We started the webinar in 2021 with an intention to shed light on clean energy issues and themes with education as the focus. Next slide, Tori. A quick insight on our Power Hour webinars. To date, we have hosted 32 webinars and have invited energy thought leaders and experts locally and nationally. Between 2023 and May 2024 Power Hour webinars, we've had more than 900 attendees that tune to our webinars. As I mentioned earlier, we record these webinars and we post the recording and the presentation slides on our website. So based on our metrics that we have gathered, we have found out that a lot of the people actually come to our website after the webinar to watch the recordings for educational and training purposes. Between 2023 and May 2024 webinar that we hosted last month, we've had more than 1,400 views on our webinars and more than 2,100 clicks. To date, the most popular webinars have been on the state of wind energy development that we hosted last year, renewable energy financing for distributed generation projects this year, and clean energy future for public schools challenges and solutions, which was our first webinar of the year. So if you want to access all of these webinars, you can do so by going to our website and accessing About IPA Events page. I really want to also thank our stakeholders for supporting our webinars for such a long time and really taking interest in watching them. So this is the fifth webinar of the year that you're tuning into, and our sixth webinar of the year will be on long-term regional transmission planning and state initiatives around the issue. The registration for the webinar will be announced soon on the IPA website. Next slide, Tori. This slide just gives you an overview of who we are as an agency. We are an independent state agency established by Illinois law in 2007. We're responsible for power procurement of eligible retail customers. They're basically residential and small commercial customers of Illinois electric utilities. On the renewable energy side, we implement the Renewable Portfolio Standard, and we do that by creating and implementing the long-term renewable resources procurement plan every other year. And we also do renewable energy procurement for utility scale projects, and we manage the solar incentive programs, Illinois Shines and Illinois Solar for All. Next slide, Tori. Now let's welcome our esteemed speaker for today. Our speaker for the webinar is Jeremy Kalin, Impact Counsel attorney at Avison Legal, a boutique business law firm in Minneapolis. In this role, Jeremy leads Avison's work on behalf of public and private clients seeking to leverage new tools in the Inflation Reduction Act and other legislation, particularly for solar, geothermal, energy efficiency, and other related tax incentives and deductions, including the first ever refundable investment tax credit. Previously, Jeremy has served in the Minnesota House of Representatives, chaired a White House task force on clean energy and climate policy and investment under the Obama administration, and served as CEO of a clean energy financing business, which he founded. During his free time, Jeremy enjoys gardening, competing in triathlons, and making pottery. Jeremy, thank you for being here today. We really appreciate it, and the floor is yours.
Well, thanks, Megha and Tori and all of the IPA team for the invitation and putting on these power hours. Really, really helpful. And I am going to try to join the transmission planning power hour because I work all over the country, and including with several clients in Illinois on projects, and transmission is actually how I cut my teeth back in the mid-90s on energy policy. As a potter, like most lawyers and politicians, I have a Bachelor of Fine Arts in ceramics, and got involved in some community power line issues that continue to, of course, be at the core of the clean energy transition. So thanks again for the invitation. I'm just going to get right into the Inflation Reduction Act and substance, and we have a lot to cover, and I want to make time for dialogue. And you'll see this weird little gray box, some of you might, that I know the IPA team is working on figuring out why it's there and minimizing it when it happens. So Tori, if you could go to the next slide, please. The last Congress was one of the most productive Congresses in the last 3 or 4 decades. Particularly on our work on the Clean Energy and Climate Action. The CHIPS Act focused on manufacturing support and the supply side. The Bipartisan Infrastructure Act, the IIJA, focused on core infrastructure, roads and bridges, and some energy transmission work and energy infrastructure. I'm going to focus on the Inflation Reduction Act. You can go to the next slide, maybe even click through 2 here. And so if you go to the next slide, Tori, there we go. So the Inflation Reduction Act, there's an asterisk about the cost, because it was originally scored at $550 billion, in that neighborhood, by the Congressional Budget Office. I've seen recent scoring of the total impact through 2032 of $1.2 trillion to somewhere in the neighborhood of $2 trillion. I actually think our challenge and our opportunity is to blow that number out of the water. And I'll tell you why. Here, if you look at this nice chart from McKinsey on the original scoring of the budget of the budget cost of the Inflation Reduction Act, you had direct spending to agriculture, energy, the EPA, and there was some significant work done on health and human services issues. But as you can see, the bulk went through the Department of Treasury. Why? Well, the changes to the tax code I'm going to walk through were certainly the most robust changes since the 1986 Tax Act that was brokered by Tip O'Neill and Ronald Reagan. And really in climate, and clean energy, it was the biggest investment in the history of any legislative body ever. And because of the way that the tax code was leveraged by the Inflation Reduction Act, we actually have an opportunity to basically take the blank check on climate investment and just fill every single possible project and increase federal investment in these projects under the law as it stands now. And I think we're, knock on wood, we've survived the biggest attack on the Inflation Reduction Act to date, and I doubt that there will be, or I'm hopeful that there won't be any meaningful attacks that we should be worried about. So I'm going to talk about the law as it stands with some confidence, a degree of confidence that we are in good shape. So if we could go to the next slide, Tori. So again, the Inflation Reduction Act, working on that $500 billion issue. If you go to the next slide as well, Tori, many of you might be working on Greenhouse Gas Reduction Fund, Solar for All funding, or other direct funding that is typical federal appropriation. There's also the consumer spending, consumer investment, things like the electric vehicle tax credit for individuals, things like geothermal or sort of ground source heat pump support for individuals, et cetera. But the bulk of what I'm going to talk about is in that commercial space. And that's actually where, and when I say commercial, I do also mean publicly owned and tax exempt organizations, et cetera. And again, that's where the $173 billion number could actually end up being 1.7 trillion or more through 2032. Next slide. So you may have seen this list before. This is not the exhaustive list, but the IRA expanded or added new tax credits, expanded existing tax credits all over the map, from the 30C alternative fuel vehicle refueling credit, which is the electric vehicle charging infrastructure credit, to things like the clean hydrogen under 45V. The carbon sequestration has been expanded under 45Q. The 45X is, I believe, new for advanced manufacturing. Obviously, nuclear is there as well. And there are a number of other credits. The 48C and 48E are titled similarly, but are structured slightly differently. Next slide, Tori. I'm going to focus on, back one. I'm going to focus on the Section 48 investment tax credit. And just a little note that the 179D energy efficiency buildings deduction was also significantly expanded and made more accessible for tax exempt organizations. And it has real value. But I'm going to focus most of my time talking about the Section 48 credit. Go ahead, Tori. So the kinds of technologies that are defined as energy property under Section 48 range from solar generation, so solar PV, to also include solar hot water, to, as you'll see on the bottom, or third from the bottom, energy storage, which is given its own category, as most folks probably know. Things like microgrids. Biogas was expanded in its eligible technology definition. And you'll note that geothermal and ground source and water source heat are separate technologies, because geothermal is actually true geothermal going through the crust of the earth. So I think when we all use the term geothermal, we're usually meaning ground source heat. But really pleased to see this dramatic expansion of Section 48 eligible technologies. Next slide. So again, I'm going to focus on solar PV just for an example, but many of these considerations apply to all the other technologies. Next slide. So there's a kind of two-tier system that most of you are probably familiar with. No surprise that a Democratic Congress insisted on emphasizing projects that use prevailing wage, pay prevailing wage, and meet the Davis-Bacon federal requirements. And also engage apprenticeships. So if you go to the next slide, you'll see that the two-tier rate actually starts. You probably all thought of the solar investment tax credit as a 30% credit. You were correct. The Inflation Reduction Act technically sets the base credit at 6% for projects that are 1 megawatt and above AC rating for their nameplate capacity. If you do not pay prevailing wage or meet the apprenticeship requirements, meet the apprenticeship requirements, you'd get a 6% credit against the cost of the project or against the basis of the project, which we'll talk about. But if you do meet prevailing wage and apprenticeship requirements, then the base jumps up to 30%. Interestingly, I do most of my work on community scale projects that are aggregations of smaller projects, each of which are under 1 megawatt. And so I typically am able to start with the exemption that says these projects get that 30% base credit. Interestingly, excuse me, the IRS has applied that 1 megawatt standard to equivalent BTUs for things like solar thermal, energy storage, ground source heat, et cetera. So that 1 megawatt exemption is pretty well laid out, and I'm going to talk about the credit as a 30% credit. Next slide. So let's talk about the basics, excuse me, and the basis of the credit. So when we talk about an investment tax credit as 30% credit, it's 30% of the basis of the project. So I'm using this example here of $1 million project, $1 million cost project. There are two ways to determine what that basis of a project is. And, with the expansion, the CEJA in Illinois, you actually have a robust and viable REC market, and in some cases, and may actually get a third-party appraisal. Excuse me. I'm happy to be corrected if needed, but so the third-party appraisal that can be greater than the cost of a project. So it's basically what's the net present value of all of the future revenues. In many states in which I work, and here in Minnesota, we use just the cost basis. So that $1 million cost of the project is what I'm going to talk about for the basis. So $1 million project cost would result in a 30% credit equal to $300,000. Next slide. That $300,000 credit is a non-refundable credit for all except for tax-exempt entities that are going to take advantage of the direct payment that's new under the Inflation Reduction Act. But I want to talk about, if this has been a non-transferable and non-refundable before the IRA, how do we monetize this potential $300,000 credit? Well, if a building owner, that's a for-profit building owner, puts the $1 million solar project on their roof and they own the solar project, they can receive this $300,000 credit. It thankfully can look back 3 years to offset federal taxes paid, or can be carried forward as long as now 22 years. Obviously, its value erodes over time, but if you only paid $100,000 a year to the federal government, you would spread that tax credit out over 3 years and could monetize the entire credit. You also, as the owner of the system, could deduct the depreciation expense that sometimes can be of greater value than the credit itself. Next slide. So a second, I've got a little background noise from someone who isn't muted. Tori, if you could catch that, that'd be great. Second, for profits, I was muted, but I unmuted myself. So for profit solar owners, if they don't have that tax credit, if the building owner doesn't have that tax credit, and I know Tori's working to get rid of those boxes. You can do a traditional lease and power purchase agreement where a third-party for-profit solar owner owns that solar and sells the power back to the homeowner. That way, whether it's a nonprofit building owner or a for-profit building owner that doesn't have the tax credit, this third-party ownership model that you all are probably familiar with allows for monetizing the investment tax credit. This structure has actually been in place since the mid 1990s when wind was getting developed here in Minnesota, and we developed the Minnesota Flip wind model before my time. But it has been the primary way to inject third-party capital into solar projects. But you need to have the right kind of income. I'll talk about this when we get to transferability, and the right kind of structure that you really need to work hard to comply with all the tax rules, et cetera. And the IRS, or the IRA, excuse me, did not expand the passive loss limitation and those rules as they apply to energy investments. It's one of the things I advocated for back in 2010 and 11 when I was working with the Obama White House and needing to find ways to not just make wealthy people wealthier, but truly spur community scale development. So I'll go to the third slide, please. Or the next slide, excuse me. So the one thing that the Inflation Reduction Act did do in the for-profit environment is allow a business owner or a solar owner of that doesn't matter about the business structure, the solar owner that's not eligible for the new direct pay to actually transfer the credit to an outside party for cash, known as transferability. This is the new section 6418 of the tax code. So this can be powerful because we don't have to go through the partnership structures. We just have to expand or transfer through a purchase agreement the tax credit through another party. The interesting thing is all of my colleagues around the country who are tax credit lawyers, some of which who are actually tax lawyers through and through and write expensive tax opinions on these deals. This is really the first time that a tax credit has been able to be sold as a raw sale rather than going into partnerships and the other structures. I'm actually trying to close my first transfer credit purchase agreement in the next couple of weeks here. They're not the most efficient contracts I've ever been able to write because that buyer of the credit still has to have the same kind of taxable income that I just described in terms of the passive loss limitation and other issues. So basically, you have to have a large tax bill and the right kind of tax bill from passive income or to be a commercial real estate professional or a corporation in order to be able to buy that credit. This transferability has solved some of those partnership headaches and some of the timing issues. So it does have use, but it is not the knight in shining armor coming to save the day that I had hoped it would be. Next slide. We're going to shift to nonprofits. So for a nonprofit solar owner, you can go back to slide 1 there with the gray building or the option 1. The nonprofit solar owner still can lease their roof or their property, their land, to a for-profit solar owner who would then be able to monetize all the credits and have a power purchase agreement or host a community solar project like y'all have in Illinois, as we have in Minnesota. That traditional lease and power purchase agreement model still works. Next slide. But I am most excited about the elective payment provision, the new 6417, known as direct pay, for nonprofit solar owners, whether on your building or on just closing on a portfolio of residential solar for low-income folks in a southeastern state, millions and millions of dollars of deployment. The nonprofit will own the system and lease the roofs of these homeowners and provide to them significant discounts. And this is in a state that has no rec market and not a whole lot of incentives. In fact, it's been challenging there. And even there, because the nonprofit owns the solar, they can actually take a direct payment of that credit. So if a nonprofit owns the $1 million solar project, they can claim a $300,000 non-refundable credit that all of a sudden is refundable. This is the whole blank check of the Inflation Reduction Act. If a nonprofit owns the energy asset, they can actually get a direct check the year after the project is placed in service for the value of that investment tax credit. There's no depreciation deduction because there's no other taxes to offset, but this has dramatically expanded the field and the potential beneficiaries of the investment tax credit for solar and all the other Section 48 energy properties. Next slide. So that energy property owner starts with elective payment eligibility analysis, meaning if you're a nonprofit organization that's exempt from taxes, so think of a traditional 501c3 charitable organization, like I know in Chicago, Elevate Energy, great example of a nonprofit organization that could own those assets and get the direct payment. Governmental entities like the Illinois Power Agency, for instance, can also own the energy assets and get the direct payment of the credit. We're working with lots of wastewater treatment plants that are doing biogas digestion and making productive use of that renewable natural gas and capturing all that potent methane to avoid the greenhouse gas emission. And 30% at the minimum of those projects can be captured through the elective payment of the investment tax credit. Rural electric cooperatives, they have to be 501c12s, are also eligible, as well as tribes and tribal entities. So Section 17 corporations or other tribal entities. If you're in one of those applicable entity orgs or types, you can get the direct payment. And if you're not, then you can take advantage of the 6418 transfer. But a nonprofit organization cannot own the energy assets and use the 6418 transferability. They have to take it as an elective payment or shift the ownership of the energy property at the time that the project gets placed in service to a for-profit that can then take advantage of the direct investment or the transfer. Next slide. I covered this as well, so thanks. I didn't realize I doubled that slide. Next slide. All right, so there's a key provision, if you go back one step of the requirements, there's a key provision in the elective payment that all, in 6417, that all nonprofits need to be aware of, and any for-profit purchasers of the transfer as well. But on the nonprofit side, you have to be the owner of the system under the income tax code, which means you have to own the solar system or the energy property for at least 5 years, because that's the time frame during which the IRS can recapture, meaning in the first year take back 100% of the credit plus potential interest and penalties, 80% the next year, 60, 40, 20. And then finally, after 5 years, you're outside of that recapture window. But you have to own the system. You have to have title, risk of loss, control, etc. Typically, we say having insurance. So you have to be very careful about the structure of these projects to make sure that you don't expose yourself to a recapture of that penalty or of that credit plus penalties. Interestingly, on the transferability, the buyer of the credit can't have any interest in the project. They have to be a total independent buyer, yet the buyer of the credit still has the exposure of recapture. So we're seeing things like recapture insurance, guarantees, etc., to basically ensure that that buyer doesn't have the risk that they could lose the value of that credit out of no action of their own. I covered who is eligible. I did mention that there's no additional depreciation benefit. And, you know, if the Illinois Power Agency, just to pick on an obvious example, were to own the system, the IPA does not need to file, as far as I know, as a state entity, any federal tax return. So for the first time, you'd be filing a Form 990T, which is for exempt business income, along with Form 3468, which is the general investment tax code tax credit form, and the general business credit form of 3800. So kind of funny to be applying for the first time, or actually having to file a return for the first time. And so we're seeing a need to walk through folks. We're seeing a couple of platforms emerge. Full disclosure, one of them has become a client of mine, and I'm in discussion with another, because we need help facilitating the filing of these credits for those that have never done so. And there's some requirements that you register your intention to get this, so then the IRS on their portal, can track the specific coordinates of every system, so there's not double counting or triple claiming of credits. Next slide. So I mentioned this pre-registration process and the property specific number required there on item 3. I do want to clarify or bring up one key consideration on elective payment. If a project is placed in service today, June 2024, it's a 2024 credit. And under the 6417 elective payment rules, the next year for your 2024 tax return, you have to file by November of 2025. Initial deadline's May, but the IRS won't process your payment or your claim, excuse me, until November of the following year after you placed it in service. So it could be 18 to 24 months between when you place a project in service and get the cash. So we're seeing the rise of things like the Illinois Finance Agency, I believe, is looking at this, of these bridge loans to lend against this future revenue of the tax credit. And there's some other idiosyncrasies I'm happy to talk through either generally during the Q&A here in a few minutes, or specifically to explore your situation and help you understand how to make sure that you can maximize that credit and the ownership, and to manage the timing of the payment. Next slide. There's one other special rule to be aware of, which is that any tax exempt income. So if you were to get a grant for that $1 million project, a $750,000 grant that is specifically for the purchase, acquisition, construction, installation, et cetera, of the equipment, then that $1 million project cost and your $750,000 tax exempt income, your $300,000 investment tax credit has to be reduced so that the grant, the tax exempt income, plus the credit do not exceed $1 million of the project cost. This is really important if you're relying on public sources of assistance. A loan is not considered tax exempt income, but a forgivable loan is. An unrestricted grant to an organization is not considered, but a restricted grant for the purpose of constructing, installing, acquiring, purchasing, etc., is considered that tax exempt income. So watch that carefully. Next slide. I talked about this challenge on the transferability, and just note that you have the same compliance as if you were the owner of the property. And again, the IRA really did not expand the pool of potential tax credit investors, while it dramatically expanded the supply of the credits. So it's actually resulted in being more of a buyer's market than it was before. And that's why I'm so bullish on the direct payment, not transferability, as the biggest avenue for expanding federal investment in climate projects. Next slide. I've covered this well, but let's go. We're about to jump into the bonus credits real quick, and then we'll move to Q&A. So next slide. All right, so there are a bunch of adders on the solar side, at least we'll talk about, that can increase that $300,000 potential credit for that $1 million project. And so let's talk through them. Let's go to the next slide. And one more beyond this. So we started the 30%. And then one more slide after this. The Energy Communities bonus credit is pretty exciting because, so Tori, if you could click to the next slide here. There are 3 different ways to qualify for the 10% Energy Communities bonus. And if you go to the Department of Energy website on the Energy Communities bonus, you'll see some maps here that really look at, if you think about this is the, some people call this the Joe Manchin provision because of his representation and advocacy for West Virginia and their fossil fuel industries and the transition. So either if you're in a county statistical area with high fossil fuel employment or with a significant amount of revenue, think some areas in Wyoming, from fossil fuels, a project located in some of those census tracts can get this 10% bonus to take the credit up to 40%. The coal closure, a recently closed coal mine or coal power plant, also gets you there. And again, there's good maps. And then on the brownfield side, unfortunately, the federal EPA has taken the position that they have not yet been directed by the IRS to clearly delineate which brownfield sites on their list are eligible. It's understandable. And several of us have requested the IRS formally ask the EPA to do so. And I know that there's discussion going on, but we're not there yet. Therefore, to ask the Illinois EPA or the IPA or others to make that designation is a challenge. Instead, the safe harbor that the IRS has established is that for projects, depending on your size, smaller projects, I think it's 5 megawatts or under, if you have a phase 1 environmental assessment, that gets you in the safe harbor, provided it shows contamination, not mitigated contamination, existing contamination. Excuse me. And phase 2 is required for those larger projects, again, showing existing contamination. Those are the safe harbors to get this 10% credit. Next slide. There we go. Thank you. And then go to the next one. You're getting my rhythm here, Tori. So the domestic content bonus is really exciting and a bonus, not an entitlement. And as a result, the current guidance has been a little bit challenging, although gotten a tiny little bit easier to access the domestic content bonus. But you must use all structural steel and iron as US-made steel and iron. That's rarely a big issue in rooftop solar projects, a little bit more present in some things like carports, but that's typically easier to achieve. The challenge is that 40% of all manufactured products and components must either be 100% US made or meet this threshold to be determined to be US made. The rule right now requires, even with the safe harbors, some exposure or transparency on specific margin and cost items of every single line item of components. And unfortunately, the taxpayer, meaning the owner of the system, is making a claim under the and thanks, Jonathan, for sharing the information you're sharing in the chat on the Energy Communities. Really appreciate it. Is the owner is making a claim under penalty of perjury that they met the domestic content bonus, but the information is actually coming from the suppliers. And so there's, again, a little bit of that disconnect. The IRS is curing some of this as they go through final rulemaking, but we've given notice to them that there's a structural issue here, and I know they're working through it. That 40% threshold increases next year, I believe, to 45%, and ultimately will reach 55%. Note that for projects starting next year getting elective payment, you will have to meet the domestic content requirements or risk not getting your elective payment as well. So we need this robust manufacturing presence to meet the goals of the Inflation Reduction Act. What I love is that the IRA was not just a climate policy; it's a manufacturing policy bill, and has put its money where its mouth was on the what Congress did, where this kind of supply side and demand side credits and support are matching up. And so the things are really ramping up nicely on the supplying side, but it's still not the easiest bonus credit to get. And then let's go to the low-income bonus credit story. Thank you. I got a couple more minutes here and we should be able to wrap up. So the low-income bonus credit is stackable on top of the others. It is the only credit that's got a limited national capacity. So 800 megawatts can be awarded by the Department of Energy for projects that are located in low-income census tracts that are eligible for the New Markets tax credit. There's a simple map that the DOE has finally built, which is lovely. 200 megawatts for projects located in Indian country on Indian land. Next slide. Those first categories are 10% bonus. And the category 3 and category 4, you actually get a 20% bonus if you meet the requirements for being on federally supported low-income residential housing projects or connected to and serving. There's a little under almost 225 megawatts of capacity available. And category 2 and category 3 were under used in the 2023 award cycle, which I'm very pleased to see that the DOE did not cut that down, but has kept it, actually increased it a little bit. And then category 4 is really for community solar projects that benefit the majority of their subscribers are getting 20% savings and are qualified as low-income households at 80% AMI or less. I expect that most, if not all, of this roughly 2.1 gigawatt capacity for 2024 will be used, but you should absolutely pursue it. The deadline for priority applications expired last night at 11 p.m. Central Time. We were in the office till 9:20 getting final projects applied for and in. It's been a full couple of weeks. But I do expect that some of these categories will have capacity remaining. So pretty exciting opportunity to get to 30 to 40, 50, 60, even 70 for an ideal project if you met the other requirements. Next slide. The one tweak or the one quirk about the low-income bonus credit is that you have to be very careful that you have projects ready to be placed in service, or at least can meet all the documentation requirements of the application, but do not activate a project before the IRS, before the Department of Energy gives you the allocation letter. Otherwise, if you place it in service, you will not be able to claim that low-income bonus credit. So there's been a little bit of timing issues around the awards and the reviews. I mean, there were thousands and literally tens of thousands of projects that needed review in November and December last year. They were very thorough, very accurate, very helpful. But we had several projects that just had to wait to be interconnected. So don't waste your low-income bonus credit if you don't have the allocation letter. Next slide. I'm just going to end by pointing out that, as I did at the beginning, that energy efficiency really is limited to things like geothermal investments and solar thermal investments under Section 48. That the building's energy efficiency deduction deserves some attention. I'm not going to go into the detail here because I've already probably bored you all to tears with my lawyer speak and the details. But as somebody who cut my teeth on energy conservation and energy efficiency and went to architecture school, but don't practice as an architect, of course, now practice as a lawyer, but I care deeply about green building and energy conservation as the first fuel, as the first alternative. You have to be, it's just the reality of the incentives are heavily steered towards changing our fuel types, and not really towards just tightening up a building envelope, although the 179D deduction is worth pursuing and can be monetized like the elective payment a little bit. Next slide. I think this might be the end. All right, so I'm gonna get a drink of water here to clear my throat and look forward to the Q&A.
Thank you, Jeremy, for providing such valuable insights on IRA tax credits for solar projects. I am monitoring the chat, and if anyone wants to just also raise their hand, we can definitely unmute them. So if you want to do that or just submit your question in the chat, that's fine as well. While we wait for these questions, quick question that I have, and I know these are some of the questions that you had recommended earlier that might be helpful for the audience. So given the deadline for applications yesterday at 11 p.m., should people still consider applying for the LMI bonus credit for solar projects?
Yeah, they absolutely should. I think the timing will be something along the lines what it was in early November 2023 at the first round, which is soon the DOE will release a dashboard of the available capacity, how many applications came in, what's been reviewed, what's been granted, and then the total available capacity. And so we saw projects get submitted as much as 3 or 4 months after the initial deadline, and that was under slightly smaller total capacity get approved. So, you know, the nonprofits and others that can get into the additional selection criteria, preferred treatment for ownership, as opposed to just a for-profit developer, you'll get a preferred treatment and hopefully be able to be in a higher subcategory of those 4 different credit types. But it's absolutely still worth taking a few minutes to apply. I mean, we've gotten good at working with clients to get them applied, but you know, it takes 20 to 30 minutes if you have all your application materials put together, and well worth the time.
Sure, thank you. We have tons of questions. Another question is from IPA Communications Manager Brian Hebner. He wants to know, are there any provisions or incentives that specifically benefit developers of renewable energy projects as opposed to the owners of these projects?
That's a great question. Really great question. And the short of it is that the lack of expansion around or limitation, lack of addressing the passive solar or passive income loss rules really means that you have to have the right kind of tax appetite. That said, because solar developers are typically engaged in the business of commercial real estate by definition, every solar developer should be taking the maximum available investment tax credits to reduce their federal tax bill to 0. I'm a progressive. When it comes to tax policy, taxes are the price of a civilized society. But ironically, this is the way to get the federal government to spend and invest in climate action and clean energy projects. So if you're a solar developer or a renewable energy developer, you should be working with your accountant to get that tax bill to 0. However, because it's not a refundable credit for for-profit folks, then you hit that limit. However, there are ways to now, because of the transferability, to split. So typically a tax equity partnership has the developer owning 1% and the tax credit investor getting 99% of the credits. That's the start of that partnership flip model. But to your question, Brian, now the partnership can keep some of the credits and then transfer a remaining balance. And we're seeing a lot of creative work that sidesteps that previous limitation. And that's where transferability has actually been really fun.
Another question from Zach Witt. Zach wants to know, can the 10% energy community bonus be combined with the 10% domestic bonus, therefore bringing the total tax credit to 50%?
Yes, the adders are all stackable. So you can do any of that combination to get there, you bet.
Another question from Vera Davkova. Vera wants to know if we applied for additional 10% and will get approved, can we transfer that additional credit to an investor or a different third party?
I believe the answer is yes. Vera, I think I'm making myself doubt my own confidence in this to get to 100%. But I'm almost certain that the answer is yes. If someone on the line can throw into the chat a correction, please do. But in general, the transferability, you just have to vest the adders onto that project before it's placed in service. And then when it's placed in service, you can either claim the credit yourself, get the direct payment if you're a tax exempt organization, or transfer the bulk of, all of that credit as one package to others. So I'm talking myself closer and closer to 100% confidence, Vera, that the answer is yes.
Thank you. Another question from Jessica Calling. Jessica wants to know, for nonprofits that want to own solar, how does the process work for them to do that with the direct pay option? They still need to come up with the rest of the system cost, right? And it can be a municipality. It needs to be a nonprofit.
So let's start with the last part of Jessica's good questions. A municipality is an eligible and applicable entity, is the term under the 6417 code to take advantage of direct pay. So, we're working with cities that are owning solar systems and taking a direct pay. We're working with cities that are owning qualified biogas digesters and other equipment to take the direct pay. And it can be a state government. It can be, like I said, IPA. It could be a local economic development commission, as long as it's a local instrumentality of a political subdivision, of the city, the state, the county, or a creature of the legislature, as sometimes happens. So then, yes, so $1 million project cost that gets a $300,000 credit, you do have to come up with that $700,000. And there are any number of ways of doing so. Tax exempt financing by issuing your own bonds is one option. There's lending available. There are a lot of different options to doing so. And particularly in Illinois, with the clean energy legislation and the many programs that are now up and running, subject of all those power hours, there's plenty of revenue to support these projects as cost effective from the start.
Great. I believe you have answered this question. This is part of Jessica's question. For nonprofits that want to own solar, how does the process work for them to do that with the direct pay option?
Yeah, thanks. So you have to, once the project is placed in service, so before it's placed in service, activated, energy is flowing through your meter, you've got the switch turned on. You have to make sure that you're meeting the requirements of the ownership of the project. But once that's placed in service, then you pre-register with the IRS portal. And then for the tax year's tax return deadline, which is May 15th for the year following, or November 15th if you're using the extension date, if it only on your original return. So like you can't amend your 990 tax return if you're a nonprofit entity that needs to file a 990. You can't then file it on amendment. It has to be on your original return. But for a municipality, you're not filing a return anyway. So you're just in the year following the project that was placed in service, filing the 990T and forms 3468 and 3800, and by the deadline of November 15th. And then we think the IRS is actually going to be pretty quick, 60 to 90 days at most, in turning around that payment and paying via check or wire to your bank account.
Great. Another question from Zach. He wants to know, Jeremy, you mentioned the tax credit to spread back 3 years of taxes. Which tax form is that under? And do you then receive a refund for those previously paid taxes?
So folks should work with their CPA. So that first elective payment does not allow for back for amending your back returns or applying to a previous year for obvious reasons, because it's just a check you're getting. And like I said, you have to file it on your original return. For-profit tax credit claimants, you work with your CPA or tax preparer to then file an amendment. And so a project that, let's say you paid $100,000 taxes in 21, 22, and 23 each, put that $1 million project into service in 2024, and you get a $300,000 credit. You'll then file an amendment to your 21 taxes, to your 22 taxes, and then your 23 taxes, in addition to the 3468 and 3800 claim credit forms in general. And then soon after filing the amendment, after the IRS processes your amendments, yes, you will get your a check from the IRS for the taxes you previously paid. So you can imagine, especially with transferability, where you don't have to be involved in the project, can buy the credit at 85 or 90 cents on the dollar. So $1 million of credit, you might pay $900,000 for that credit, and then be able to offset all your other taxes you've already paid. So all of a sudden, for $900,000, you could get $1 million of taxes back from the federal government within a matter of weeks or months. Pretty good return. As you might imagine, many people that have some wealth or in the business community detest taxes more, so like $1 of unpaid taxes, of avoided taxes, is worth more than $1 of earned revenue after tax. It's an interesting psychology, and it is what it is. But I'm seeing a lot of activity in that market with transferability right now.
Thank you so much. I know we have 4 minutes left. We can go ahead, probably ask 1 or 2 questions to you, Jeremy. Another question is on direct pay. So direct pay seems like an easier pathway for lots of smaller projects and community-based projects. Is that what you're seeing in real world projects as well?
Yeah, I've just become this massive advocate and fan of direct pay. It just is the easiest, fastest channel to getting 100% less the transaction costs, but 100% of the value of that credit directly into the project. And especially where you're doing projects that have such community benefit, that have been really challenging to attract, aligned value investors on the tax credit market, that you can just skip that conversation and just go right to monetizing the credit. You do have to, as the previous question came up with, you do have to truly, what was I going to say? I lost my train of thought. I apologize. Too many people texting me about tax credits
No problem.
at the moment. So
Yeah, so if that's something you're seeing in real world projects, and are tax equity partnerships or tax credit sales still viable pathways for smaller projects?
I think they are, but again, I have had so many theoretical conversations around, gosh, if I could find a bank that still has a tax bill and is a C Corp, if I could find this investor, if I could find that investor, it's been, you spend so much time, the opportunity cost of chasing these investors, giving away your destiny to other investors. That's why I love the direct pay, is you just have to make your own determinations around what your risk is and what the economics of the project look like. And to be honest, the risk is so moderate. It's really manageable if you're structuring the ownership right and not trying to get too cute by half. That I just think it's worth pursuing. And especially if you can develop projects that can take advantage of the low-income bonus credit or other bonuses where you're getting 40, 50, 60% back from the feds. It totally changes the project economics.
Sure, that makes sense. Another question from Jessica. Jeremy, what states do you work in? I know Illinois and Minnesota. Any others?
I work all over the country. I work wherever people need some, we're a boutique business law firm. So, we have lower overhead, as you can probably tell. Our culture is pretty relaxed. And I like working with, folks that need good project finance and creative structuring advice, and are doing good in the world to all sorts of in all sorts of ways. So we can work all over the country. I've not yet seen. I did actually have to get admitted to the District of Columbia, where they have this great Solar for All program as well, that I know the Illinois program was modeled partly after. But we are able to work everywhere in the country, and we just added another solar lawyer who's awesome on the regulatory side too. So navigating those utility rules that change everywhere all the time has gotten easier for me because I have a bigger brain than mine on that front as part of the team too.
Thank you. One last question. We've been getting a lot of questions. This is pretty popular topic. This question is from Edward Strickland. Edward wants to know, please speak a bit more on what grant dollars are netted off the direct pay. Are grant dollars for development treated differently than grant dollars for construction?
Well, so if I was still had my political hat on, I would filibuster long enough for me to pull up the specific final rules released on the 11th of March. Let me get back to the Zoom so I can see you all while I answer this. And the specific rule, and it's really worth looking up. So when you find find that notice, the final rules released, and find the PDF of it, you'll find the no excess benefit from restricted tax credit amounts, tax exempt amounts on page 155. And specifically, it says the determination of whether a tax exempt grant is made for the purpose of purchasing, constructing, reconstructing, erecting, or otherwise acquiring an investment related credit property is made at the time the grant is awarded to the applicable entity. Development, I would say, falls within the definition of constructing, purchasing, constructing, reconstructing, erecting, or otherwise acquiring. That said, one of our Minneapolis green cost share programs that I'm very familiar with is a per kilowatt hour production incentive paid once in the first year, 60 days after the system's been placed in service. That we believe that we've classified as not tax exempt income that would reduce that credit amount. So it's a very surgical, lawyerly analysis that we have to take on.
Thank you. I know we're at 102, but this is something Zach wants to confirm really
Yes.
quickly with you, Jeremy, before we let you go. To confirm, you mentioned that nonprofits next year will not receive direct pay if they do not meet domestic content 40 or 45% threshold. Is that in effect starting 2025?
So there's actually an open question that we've asked the IRS to chime in on. I don't expect them to do this immediately, but it is not clear what 2025 projects, the project commenced in 2025, are going to look like in terms of the domestic content requirements for elective payment. So I wish it's one of the very few areas where I think the intent is clear that you need to meet it or get down to zero and don't get any elective payment requirement or elective payment. But actually the rules are not, there's a missing link. And what I just remind folks on, or remind folks about, is the bill passed the Senate with 50 votes, 50 Democratic votes, no Republican votes. And then of course the vice president is the tiebreaker. And that coalition went from Bernie Sanders to Joe Manchin. As soon as the deal was struck with Joe Manchin in Senator Schumer's office, a friend of mine was actually negotiating that deal, standing in for Senator Manchin in the negotiation. There was not time or risk. You do not want to, in politics, if you have the votes, you don't want to risk losing any single member of that coalition when you don't have any votes to spare. So there was not an opportunity to go around to the community and the stakeholders, even go to the IRS, go to the Department of Energy, and have anybody vet any provision that was tweaked during that negotiation. So that's why there are some questions like this one, and that's why we've had to rely so much on the thousands and thousands and thousands of pages of IRS guidance and rules, because there's some things that just aren't clear. It's frustrating. And I just ask that people bring a little bit of compassion and appreciation for the courage that the Senate took in saying, hey, we need to get something done. The climate crisis is real, and community benefits need to be a key part of the solution. So it is imperfect. There's no question about it. I wish that I could answer your question, Zach, more precisely. But I would just say, let's meet the domestic content requirement for 2025 projects and onward. I will also say, and what's not clear is in 2024, projects under a megawatt don't have to meet that domestic content requirement. So that's the open question as well for 2025 is, does that rule actually apply to 1 megawatt under projects going forward? Lastly, there's an off-ramp or a safe harbor exclusion. Sorry, I'm going to use all the terms and then finally get on the right one. An exemption that if the project costs were to increase 25% overall because you can't meet the domestic content requirements, or if those components and parts are not available domestically, you can claim an exemption to the domestic content requirement. But my advice is to make a good faith, earnest effort to meet those requirements in order to secure all the domestic elective payments.
Thank you so much. I know you're really busy and we've taken so much of your time. On behalf of the Illinois Power Agency, I want to thank you, Jeremy, for sharing such valuable insights with us. For attendees that do still have questions, please reach out to Jeremy. His contact information is provided on the presentation slide, which will be posted on the IPA website sometime today or Monday morning. And I really want to thank our speaker and attendees for joining this Power Hour. This webinar wouldn't have been possible without your support. And we will see you at the next webinar on long-term regional transmission planning and state initiatives around the issue, which will be taking place on July 26th, and we will be sharing the registration link shortly. Thank you all and have a lovely evening. Bye-bye.